Diversification strategies for beginners. Hey everyone, welcome back to Finance Clarity. Let me start with a question. Have you ever put a large amount of money into one stock, one cryptocurrency, or one investment because you were really confident in it? Or maybe you've seen someone do that and make a lot of money quickly, which made you think about doing the same. Here's the uncomfortable truth. Putting too much money into a single investment is one of the fastest ways to destroy your wealth. Even if that investment looks amazing right now, things can change quickly. Companies can fail, industries can decline, and markets can turn against you when you least expect it. This is exactly why diversification is one of the most important concepts in investing, especially for beginners. Many new investors either don't diversify at all, putting everything into one or two stocks, or they diversify in the wrong ways. Both mistakes can lead to unnecessary risk and disappointing results. In this video, I'm going to break down diversification strategies for beginners in a clear, practical, and easy-to-understand way. I'll explain what diversification really means, why it matters so much, and how you can apply it to your own investments, even if you're just starting out with limited money. If you want to invest more safely and intelligently, stick around. This might be one of the most important lessons you learn as a new investor. Let's get into it. What does diversification actually mean? At its core, diversification means not putting all your eggs in one basket. In investing, it refers to spreading your money across different investments so that if one of them performs poorly, the others can help offset the losses. The goal is to reduce the overall risk of your portfolio without necessarily sacrificing too much potential return. Diversification works on the principle that different investments don't always move in the same direction at the same time. When some investments are going down, others might be going up or staying stable. This helps smooth out the ups and downs of your overall portfolio. Simply put, diversification is one of the most effective ways to manage risk in investing. Why diversification matters so much. There are several important reasons why diversification is especially valuable for beginners. 1. It reduces the impact of bad decisions. Even experienced investors make mistakes. Diversification helps protect you if one of your investments turns out to be a poor choice. 2. It protects against unforeseen events. No one can predict the future. Companies can fail, industries can decline, and unexpected events can happen. Diversification helps reduce the damage when these things occur. 3. It helps you stay invested during tough times. When your portfolio is well diversified, you're less likely to panic and sell everything during a market crash. This helps you stay invested for the long term, which is crucial for building wealth. 4. It's one of the few free lunches in investing. Diversification can reduce risk without necessarily reducing expected returns. This makes it one of the most powerful tools available to investors. Different ways to diversify your investments. There are several levels of diversification you should consider. 1. Diversification across asset classes. This means spreading your money across different types of investments, such as stocks, equities, bonds, fixed income, real estate, cash, or cash equivalents, commodities, gold, silver, etc. Each asset class behaves differently. Stocks tend to be more volatile but offer higher long-term returns. Bonds are generally more stable but offer lower returns. Having a mix helps balance risk and reward. 2. Diversification. Within asset classes. Even within stocks, you should diversify. For example, invest in stocks from different industries, technology, healthcare, consumer goods, energy, etc. Invest in companies of different sizes, large cap, mid cap, and small cap, invest in both domestic and international stocks. 3. Diversification across time. This is often called dollar cost averaging. Instead of investing a large amount of money all at once, you invest smaller amounts regularly over time. This helps reduce the risk of investing everything at a market peak. 4. Diversification across investment vehicles. You can also diversify by using different types of investment accounts and products, such as individual stocks versus index funds or ETFs, taxable accounts versus retirement accounts, 401k, IRA, actively managed funds versus passively managed funds. Common diversification mistakes beginners make. Here are some frequent mistakes to avoid. 1. Overconcentration in one stock or sector. Many beginners put too much money into one company they like or one industry they're familiar with. This dramatically increases risk. 2. Thinking they're diversified because they own multiple stocks. If all your stocks are in the same industry or sector, you're not truly diversified. True diversification requires spreading across different industries, company sizes, and asset classes. 3. Over-diversification. While diversification is good, owning too many investments can make your portfolio hard to manage and may reduce returns without meaningfully reducing risk. For most beginners, owning 10 to 20 well-chosen investments or using index funds is often enough. 4. Not rebalancing periodically. Over time, some investments in your portfolio may grow faster than others, changing your overall diversification. Without rebalancing, your portfolio can become riskier than you intended. 5. Diversifying only within one country. Many beginners only invest in their home country's stock market. Adding international stocks can provide additional diversification benefits. Practical diversification strategies for beginners. Here are some simple and effective ways to diversify as a beginner. Strategy 1. Use broad market index funds or ETFs. One of the easiest and most effective ways to diversify is to invest in broad market index funds or ETFs. These funds automatically give you exposure to hundreds or even thousands of stocks across different industries and company sizes. Examples: total stock market index funds, S&P 500 index funds, international stock index funds. Strategy 2. Build a simple portfolio. A basic diversified portfolio might include U.S. stocks through an index fund, international stocks through an index fund, bonds for stability. You can adjust the percentage allocated to each based on your age, risk tolerance, and goals. Strategy 3. Use target date funds. Target date funds are designed to automatically diversify your investments and become more conservative as you get closer to retirement. They're an excellent set-it-and-forget-it option for beginners. Strategy 4. Dollar cost averaging. Instead of investing a lump sum all at once, invest smaller amounts regularly, for example, every month. This helps reduce the risk of investing at a market peak. How much diversification is enough? This is a common question. The answer depends on your situation, but here are some general guidelines. For most beginners, owning a few broad index funds is often enough diversification. If you prefer individual stocks, aim to own at least 10 to 20 different stocks across different industries. Avoid putting more than 5 to 10% of your portfolio into any single stock. Consider adding bonds as you get older, or if you have a lower risk tolerance. Remember, the goal of diversification is not to eliminate risk completely, but to manage it intelligently. The importance of rebalancing. Over time, your portfolio's diversification can drift. For example, if stocks perform very well, they might make up a larger percentage of your portfolio than you originally intended, increasing your overall risk. Rebalancing means periodically adjusting your portfolio back to your target allocation. This usually involves selling some of the investments that have grown too large and buying more of the ones that have become smaller. Rebalancing helps maintain your desired level of risk and can also force you to buy low and sell high to some extent. For beginners, rebalancing once or twice a year is often sufficient. Final thoughts. Diversification is one of the most important and practical concepts in investing, especially for beginners. It helps reduce risk, protect against unexpected events, and increase the chances of achieving your long-term financial goals. You don't need to make things overly complicated. Even simple strategies, like investing in a few broad index funds and rebalancing occasionally, can provide excellent diversification. The key is to understand why diversification matters and to apply it consistently. By spreading your investments across different assets, industries, and time periods, you put yourself in a much stronger position to build wealth over the long term while managing risk effectively. Remember, you don't need to predict the future or pick the best investments every time. You just need to avoid putting all your eggs in one basket and stay disciplined over time. Thanks for watching. If this video helped you understand diversification better, please like and subscribe for more beginner-friendly investing content. Drop a comment below and let me know how you're currently diversifying your investments. I read every comment. I'll see you in the next video. Take care.